What is micro-lending? Have you ever wondered how small businesses can get the funding they need when traditional banks turn them away? That's where micro-lending comes into play. Micro-lending refers to the practice of providing small loans, often called microloans, to individuals or businesses that typically do not qualify for standard bank loans. These loans are usually much smaller than what banks offer, often ranging from a few $100s to $50,000. The main purpose of micro-lending is to give people access to funds when they have limited options elsewhere. This type of financing can help entrepreneurs start or grow a business, cover working capital, or purchase necessary equipment. It serves as a lifeline for many who might otherwise struggle to find financial support. In the context of bankruptcy and business debt relief, micro-lending can be particularly useful. When a business faces financial difficulties or has already filed for bankruptcy, securing new funding through conventional channels can be tough. Banks often hesitate to lend to businesses with a bankruptcy history due to perceived risks. Micro-lenders, however, tend to be more flexible with their requirements. They often focus on the potential of the business and the character of the owner, rather than just credit scores or past financial troubles. Microloans can be used for various business needs, such as buying inventory, paying for equipment, or covering day-to-day operating expenses. The repayment terms for microloans are usually shorter than traditional loans, and interest rates can vary. Sometimes, these rates are higher due to the increased risk that lenders take on. However, some microlenders, especially those committed to supporting underserved communities, may offer lower rates or additional support, like business training. For businesses considering alternatives to bankruptcy or looking for ways to recover after bankruptcy, micro-lending can provide a path to rebuild. It allows business owners to access capital without the strict requirements of traditional lenders, giving them a chance to stabilize or restart their operations. While microloans do not eliminate the need for careful financial planning, they can offer a practical solution for those who are otherwise shut out of the financial system. It is important to remember that while micro-lending can help, it is not a cure for financial distress. Business owners should carefully assess their ability to repay any loan, especially if they have already experienced bankruptcy. Micro-lenders may be more willing to work with businesses in difficult situations, but the responsibility to manage debt wisely remains with the borrower. In this way, micro-lending fits into the broader options for business debt relief outside of bankruptcy, providing a flexible and accessible source of funding for those who need it most.